Hi, I'm Steven Monacelli. Welcome to our next episode of Want the Hemp, where we discuss everything cannabis and hemp as well. Today, we're discussing restructuring as a result, possibly, of the pending rescheduling going on, as Donald Trump issued an executive order to the Department of Justice on December 18th to reschedule cannabis. The timetable is something that everyone is starting to speculate in terms of when it's effective, and just want to remind everyone that it's not effective until it's effective. And today I'm joined by Ray Owens of our tax department. He's a senior tax manager here at Withum. And we're going to be discussing, you've got a current entity structure and, you perhaps may want to re-explore whether or not that structure still works for you and whether or not you want to be something else when you grow up. That being said, Ray, what are your thoughts on you're a partnership, you want to be a C corporation, you're a C corporation. What are your options? Let's discuss that a little bit.
Hey, Steve. Thanks so much for having me today. So I'm really thinking today that the conversation is going to revolve mostly around C Corps. So a disproportionate amount of our clients elected to be taxed as C Corps. Either they came in as an Inc. or they were an LLC, and very early on, we advised them that in a 280E world, that 21% flat tax rate as a result of the TCJA, I mean, you can't argue with it. If you're going to pay your tax on your gross profit, you might as well pay it at 21%, and you might as well lock that risk in to that corporate entity box instead of flowing it through to the partnership. And with very few exceptions, that's where most of our clients went. And that's where my clients went before I even got to Withum too. It's been popular in the industry for the past decade. Really, ever since that tax law change. So there's a lot of different things that can happen. A lot of clients are calling now and they're saying, hey, I wasn't used to corporations before I got into cannabis. It still feels a little bit foreign to me. There's still some double tax ramifications. With rescheduling on the horizon, is this a good time to get out? And that's the beginning point of a lot of conversations that we're having these days. I mean, I assume you're seeing the same thing as well.
Yeah, there's no question. There's a lot of advantages to a C corporation, but certainly disadvantages. There is definitely no one size fits all on choice of entity, especially in the cannabis world. Many of the dispensaries that have been really overburdened by 280E, where they are limited in what they can put in their inventory, have really chosen the C corporation route to be operating. And now the question is, if we're not burdened by 280E, would you make that choice differently to enjoy some form of single level taxation, whether it be from operations or from an exit? So talk to me a little bit about, you're a C corporation and you want to pay dividends because now you're going to have some additional free cash flow without 280E. Ray, what does that journey look like in terms of, I'm a C Corp, I want to be taxed as a partnership. What are my options for any other flow through entity choice?
Well, when we sold C Corps to a lot of our clients, we kind of said to them, hey, don't worry about the double taxation, right? Like, first of all, it's cannabis, 280 exists. You're not going to have cash for a little while. The cash you do have, you're going to reinvest. You're going to go into other states. You're going to build up your facility. Obviously, we've seen these big, beautiful facilities come out. Now the chickens are coming home to roost a little bit, right? We're expecting more cash flow if 280E goes away. And a lot of people are thinking, can we get back to that partnership? Should we go to the S-Corp? I think we can almost cross the partnership off for a second here. It's a taxable event. Unless you wind up with a very unique set of circumstances or you're just willing to bite the bullet, going back to a partnership's not going to be your best bet. And we can discuss that more in a later podcast. I'm happy to come back. But I think the S-Corp is where we're going to talk to a lot of our clients. Because simply checking to be treated as that small business corporation with that single layer of taxation is going to be desirable from the jump for a lot of people. But they have to remember there's a number of traps if you don't think about them, right? First off, what do your investors look like? An S-Corp is a very specific set of investors that won't ruin the election. There has to be under 100 natural people. Only a certain kind of trusts can own that stock. You can't have a partnership as a partner. Number of things going on there. But we've seen a lot of these very creative financing agreements in cannabis. There's equity going right, left, and center. There's options, preferred stock, all of this. If in an S-Corp, you only can have the one type of stock. And so it becomes very rigid. And then from there, there's W-2 issues. There's big. What is big, right? I didn't come up dealing with big. Did you deal with big coming up? What even is big, right? Who
I always think big, but let's talk about what big is.
There you go.
Let's talk about what big
As
is.
you sit in the office in Boca. Talk to me about big. What do you know about big? Because you had more corporate experience coming up than I did.
Sure. So basically, if you're a C corporation and you want to elect to be taxed as a flow-through entity, you basically have this concept of a valuation is done when you make an S election. That value establishes current fair market value. The excess of the current fair market value in excess of the underlying tax basis of the assets inside the entity is measured and frozen. And it is frozen
forever?
No, it's frozen for a 5-year period. And if you exit after 5 years, you basically are locked in. The built-in gain goes away after 5 years, essentially. If you dispose of an asset in the 5-year window, you actually trigger a tax. And the tax is at the maximum corporate rate. And it is basically bifurcated on the value of that asset that you sold on the date you made the S election in excess of its tax basis on that date. That gets triggered as a corporate level tax, even though you now are living in the purview of an S corporation flow through entity. So it is a form of double tax for 5 years subsequent to a C corporation electing S. The concern that I have is inventory, because typically inventory is going to turn 3 or 4 times a year in cannabis, possibly more. And you've got a situation where you just sold an asset in that 5-year window.
Sure.
So you're going to have some kind of triggering of built-in gains when that inventory turns in that 5-year window. So that is just one example of how an S election can sting you. And as you pointed out, and you had very good comments, you have to be natural. All of these shareholders need to be natural persons. Certain types of trust can't be all trust. Less than 100 shareholders, which typically is not a problem in some of the smaller entities and the mid-sized entities. And what does that look like for operating agreements that have a waterfall whereby certain investors say maybe get their capital back first, and then the entire group of investors shares pro rata thereafter? What does that look like? An S corporation can only have one type of stock, one class of stock. Irrespective, you can have different voting rights, but you have to have the same rights and privileges economically.
Absolutely.
And many of these companies are not geared, those operating agreements that really have a meeting of the minds between the shareholders or the investors when the deals were done. We need to be able to respect the economics, which is going to limit who can actually do these S election strategies to try to get dividends out on a single level tax basis.
100%.
I think there are opportunities for companies, but I think it would probably be more of the smaller companies with a very simple structure that have an ability to go from a C corporation to an S corporation.
Couldn't agree more. And I think that big issue and the inventory is something that a lot of people are going to sleep on. Because, you mentioned the word frozen, and forgive me, 3 daughters, I immediately started playing Let It Go in my head, and now I can't get it out. I think that a lot of people are going to say, you know what? I don't have to sell any assets in 5 years. My desk can stay where it is. I don't have to get rid of any of the car or anything else that's in the company. But that inventory is going to be a problem. So I think there's a lot of people who are going to hear that, and they're going to start to ask, how big of a problem? So if that gets taxed to 21%, roughly on the day you bring it in, and then you got to pay 37% on the flow through ordinary income, well, that's quite a hit. I don't know. So, I guess, are there other ways to mitigate it? Can you take your W-2 and jack it up? Can you do some other things? Can you create other deductions in the company to mitigate that tax hit in that first year? And I don't know. It's got to be a reasonable comp. You can't simply pay yourself every single dime and zero out income, create other losses. I think it's going to be tough for a lot of people to become S-Corps. And you mentioned all, these preferred returns. I don't know if a lot of people are going to want to pay to redo a lot of the legal docs and jump through those hoops, because I think that's going to be one of your few options, is to take the preferred returns and somehow recast it as a liability. I don't even know if that's possible. It's probably going to be frowned upon. It's probably not going to be worth the effort either. So it may not be as easy to get to an S-Corp as people think.
Interestingly enough, choice of entity discussions are best addressed at the very beginning. And I typically look to see what is the more likely than not exit look like for the size entity that management and the investors plan to grow it. And everyone wants to grow to the moon, but logistically, it's an industry that has been wrought with cash access issues. And without cash, you really can't grow to a size Very interestingly enough, many of our multi-state operators have been with us for a very long time, and they grew up from inception of the first license, raised capital, raised certain series of rounds of capital to be able to get into various states, become multi-state operators. And we're not seeing that recently. In recent years, the last 2 or 3 years, access to capital has been really difficult. So when you look to see some of these companies forming, unless there is a source of funding that'll enable you to get to a size that is critical, at least big, and no pun intended, I think you're kind of stuck with where you are when you initially start. So you got to kind of stick with it once you're in it, because more likely than not, if you're a C corporation and you want to go to another form of entity, you're probably better off living with the C-Corp structure and not tampering with it, because no one wants to pay tax when someone doesn't have proceeds to pay the tax as a result of a change in expectations that they'll have some kind of an exit.
Sure.
Ray, tell me a little bit about the qualified small business deduction benefit of being an initial investor in a C corporation.
Sure. And thank you for that tee up, because that's what was going through my mind as you started saying that, is maybe staying put's not the worst option, right? There's a lot of flexibility on the exit from a C Corp. There's all types of mergers and other tax deferred ways out. If you get out completely and you're able to sell the stock, to your point, you might qualify for the qualified small business exception. Now, in the past, you had to wait 5 years. It was a little bit rigid. You had to look at your valuation, and then you would potentially qualify for the exclusion. And it got up to 100%. You know, it was a good thing after that 5 years. But the most recent tax law changes have actually created some other really desirable holding periods that allow for a little bit more flexibility. Because what we were seeing was that a lot of people, especially in this startup world in cannabis, right, where you're trying to really just strike when the iron's hot. Maybe you want to get out after 3. Maybe you want to get out after 2. Now there's options. Qualified small business stock, there's now a 3-year threshold, a 4-year threshold, and a 5-year threshold. So if you can hold it for 3 years, you could get up to a 50% exclusion. 4 years, 75. 5 years would then unlock that maximum benefit of 100%. Now, they also upped the way the valuation affects you, right? So it's up to $15 million per taxpayer, or 10 times your base. That's up from what it used to be. So this could be very advantageous to any investor who would qualify under that original issuance standard. And that's important, because if you got your stock secondhand, or if it even technically came out of Treasury, you might not qualify. And it's imprudent to go ahead and take the exclusion without talking to a tax professional. So anybody out there should definitely consult their guy before doing it.
That's good advice. I will say this, one of the things we are and will address, and I think it's a situation by situation basis, we've run into cannabis groups that have really created a very sophisticated organizational chart structure with so many entities, some licensing companies, separate real estate companies. Well, essentially anyone who buys your business is going to want to control the real estate. It's a big piece of it in terms of cannabis. So, I think rescheduling provides everyone an opportunity to take a fresh look to see whether or not any of the entities that they have in their organizational structure can be consolidated without tax consequence, to make life simple. And I love keeping things as simple as we can. And the only reason why we can't keep simple things sometimes is because there's good economic justification for doing so. But I think this provides everyone a fresh opportunity to possibly look and do a statutory merger of some of the entities on a tax-free basis to really get rid of and simplify their organizational structure.
Absolutely agree. If there's one thing cannabis companies are notorious for, it's having 100,000 entities on their org chart. If we can get that down to 1 or 2, or maybe a consolidated C-Corp, man, life would get a lot better. So I hope that for my clients, and I hope that for your clients too.
Excellent. Well, Ray, thank you for joining us today. And I'd like to thank everyone for tuning in. If there's anything we can do for you, we have a full spectrum of a suite of services with our cannabis team. Please reach out. Thank you very much.